Good day everyone, my name is Marcus, and if you're new to the channel, welcome. If you're not, thank you so much for supporting us all this while. Just remember that every like and subscription goes a long way in supporting our production. Now before we dive into today's video, have a look at these disclaimers before we proceed. Okay, for today's video we will be talking about a very exciting topic that has riveted stock markets lately. It is the issue of special purpose acquisition companies, otherwise known as SPACs, taking over the traditional IPO route. Just a quick primer into this issue for many of you who are unfamiliar with this controversy. It has become a trend in Wall Street nowadays for many of these SPACs to rise up, as many people have viewed the traditional IPO process as one that is very arduous and filled with many regulatory roadblocks that could essentially derail the stock listing appropriately at the correct prices that its developers want to, instead of other unexplained phenomena occurring. To explain what an SPAC is, a special purpose acquisition company is a company with no commercial operations that is formed strictly to raise capital through an IPO for the purpose of acquiring an existing company. So this essentially makes them blank check companies. And for those of you wondering whether it is a new trend, it isn't, because SPACs have been around for decades. And in recent years, they have essentially gone mainstream, attracting big name underwriters such as Goldman Sachs, JP Morgan Chase & Co., and have raised a record amount of IPO money in 2019. Just in 2020 alone, more than 50 such SPACs have been formed, raising roughly $22 billion. Something we must remember is that at the time of their IPOs, SPACs have no existing business operations or even stated targets for acquisition. They are basically shell companies which are formed just to accommodate the whims of an existing company. And because it is a shell company, investors in such SPACs are really diversified. They can range from well-known private equity funds such as BlackRock all the way to the general public. One important rule to note is that SPACs have 2 years to complete an acquisition, or they must return all the stated funds to the investors. Now we will dive more deeply into how an SPAC works, and I'll leave you to think whether this is better or whether the traditional IPO route is better. SPACs are generally formed by investors with expertise in a particular business sector. In creating an SPAC, the founders usually have one acquisition target in mind, but they don't identify that target to avoid extensive disclosures as required by the SEC regulations during the IPO process. And this exactly ties back to their nickname of blank companies, because the investors who are investing in SPACs essentially have no idea what they are buying into. They're just buying into an SPAC backed by some credible founders in hopes of cashing in on a lucrative company that the founders are targeting themselves. The money SPACs raise in an IPO is placed in an interest-bearing trust account, and these funds cannot be given to anyone except to complete an acquisition or to return the money to investors if the SPAC process is eventually liquidated. And tying back to what I said just now, the time limit for this acquisition is 2 years, or the SPAC will have to face liquidation under the regulations listed out by the Security and Exchange Commission. In some cases, the interest earned within this trust account can also be used as the SPAC working capital. This is a very simplified process of how an SPAC is formed, and after the SPAC goes through everything I've said thus far, it gets listed on one of the major stock exchanges. So now we will dive down into the advantages of an SPAC. Like what I said just now, listing an SPAC is a very attractive option for the owners of a smaller company, which are often private equity funds. For example, setting an SPAC can add up to 20% the sale price compared to a typical private equity deal. Being acquired by an SPAC can also offer business owners a fast track to the IPO process under the guidance of an experienced partner, with less worry about the swings in broader market sentiment if they were to go through the traditional IPO process and list themselves without the guidance of someone who has been through the process themselves. But there are definitely some disadvantages as well, and we'll talk about them. One of the most prominent disadvantages that have been listed lately will be how such companies could essentially become a form of MLM or multi-level marketing. Since investors do not know what they are buying into, the founders themselves can take advantage of this information asymmetry and use the investors' funds to put into something more sinister, rather than using it to back up a small company which they have promised the funds to. In such a case, The SPACs could face liquidation and the investors may not even get all their money back, especially for the institutional investors who have invested hundreds of millions of dollars into backing up reputable figures, all to find that their money has been gone to, in a sense, an unprofitable venture. But SPACs have definitely become more common in the recent years, with the fundraising hitting a record $13.6 billion in 2019. The fact that there are many big-name underwriters such as Goldman Sachs, Credit Suisse and Deutsche Bank who are looking for a shorter-term opportunity to maximize the return on their funds have definitely attracted more retail investors, knowing that SPACs are backed up by these traditional institutions which they have much trust in. One of the most high-profile recent deals involving SPACs would be Richard Branson's Virgin Galactic. Venture capitalist Chamath Palihapitiya's SPAC Social Capital Philosophia Holdings bought a 49% stake in Virgin Galactic for $800 million before listing the company in 2019. Another more prominent case would be Bill Ackman, founder of Pershing Capital Square Management, and the person who took a $1.1 billion shot against Manulife, sponsored his own SPAC, known as Pershing Square Tontine Holdings, raising $4 billion in its offering on July 22nd, making it the largest ever SPAC to date. So for those of you who are more interested in this phenomenon, you can definitely dive deeper into the traditional IPO process and find out how exactly it works. As an aspiring lawyer myself, I'll definitely be looking deeper into this process as well. But let me know your thoughts in the comment sections below, and I definitely hope this video has enhanced your understanding of one of the more disruptive trends in our stock market today. I've attached some links from articles which I took reference from, and I really hope that you have one key takeaway from this video which you can share with your other friends. Leave any questions you have in the comments and I'll try my best to answer all of them thoroughly. Stay tuned for the next video and invest safe.
Ever since the day that you